What if I told you that coffee you bought this morning, that streaming subscription you forgot to cancel, every single spare dollar sitting in your account could be working for you right now, building real wealth while you sleep? I know it sounds like another get-rich-quick scheme, but stay with me because I spent weeks running the actual numbers on Dividend ETFs, and what I discovered completely changed how I think about money. By the end of this video, you'll see exactly what happens when you take every dollar you save and put it into dividend-paying ETFs with automatic reinvestment. The math is wild, and it's all verified data. Quick favor, hit like and subscribe right now so YouTube shows this to more people who need to see it. Here's the concept in simple terms. Imagine every time you get paid, every bonus, every tax refund, instead of letting it sit in your checking account, earning nothing, you funnel it into dividend ETFs and reinvest every penny they pay you. No touching the money, no cashing out dividends for spending, just pure compounding. I'm talking about exchange-traded funds that hold dividend-paying stocks, companies that share their profits with shareholders quarterly. But the real magic happens when you enable something called a DRIP, a Dividend Reinvestment Plan, where those cash payments automatically buy more shares without you lifting a finger. More shares means more dividends next quarter, which buys even more shares, and this cycle keeps accelerating. It's like a snowball rolling down a mountain, getting bigger and faster as it goes. Now let me show you the real numbers, because this is where it gets interesting. I looked at the most popular dividend ETF out there, the Schwab US Dividend Equity ETF with the ticker SCHD. Over the past 10 years, this fund has delivered an annualized return of 11.15% with all dividends reinvested. Compare that to the Vanguard High Dividend Yield ETF at 8.8%. SCHD is right there competing with the entire market while paying you a 3.88% dividend yield compared to just 2% for the broad market. So let's run the 20-year projection with $10,000 invested at that 11.15% annual return. After 10 years, your $10,000 becomes $28,534. At 15 years, you're looking at $48,698. And after 20 years, you're sitting on $82,830. That's an 8.3 times multiplication of your money. Meanwhile, that same $10,000 sitting in cash, still $10,000. Zero growth. That's the difference between making your money work and letting it rot. But here's where people get confused, and I need to clear this up because there's a famous statistic floating around that says 85% of stock market returns come from dividends. That number comes from Hartford Funds research covering 1960 to 2023, and it's technically true but wildly misunderstood. What they're actually saying is that over 63 years, the cumulative effect of reinvesting dividends and letting them compound accounts for 85% of total growth. It's not that dividends alone give you 85% returns each year. In reality, looking at more recent periods, dividends contribute about 23 to 34% of annual S&P 500 returns, with capital appreciation making up the rest. From 1926 to February 2025, dividends were 31% of returns, and price gains were 69%. Over just the last 10 years ending May 2025, dividends were only 23% because tech stocks like Nvidia and Apple that pay little to no dividends dominated. But here's why this still matters. Those reinvested dividends compound exponentially over time. Even if dividends are only 25% of returns right now, reinvesting them for decades creates massive growth through the power of compounding. Let me show you what small differences in returns actually mean over 20 years. If you invested $10,000 at 11% annual returns, you'd end up with $80,623. At 11.15%, which is SCHD's actual rate, you get $82,830. And at 11.68%, the S&P 500 rate, you'd have $91,098. That gap between 11% and 11.68% seems tiny year to year, but over 2 decades, it compounds to over $8,000 difference. This is why choosing the right fund and sticking with it matters so much. Now here's the part that nobody warns you about, and it's crucial. Every single dividend you reinvest is taxable income in the year you receive it, even though you never touch the cash. If you're running this strategy in a regular taxable brokerage account, you're paying income tax on those dividends every year while they're reinvesting. This is the hidden drag on returns that can seriously hurt your compounding. The solution is tax-advantaged accounts. If you're in the United States, that means 401k plans, traditional IRAs, or Roth IRAs, where dividends compound completely tax-free. In Canada, it's RRSPs and TFSAs. When you shield your dividend reinvestment from taxes, your money compounds faster and your final portfolio value can be dramatically higher. This is non-negotiable if you want maximum results from this strategy. Setting up automatic dividend reinvestment is simple. But let's talk about what happens when markets crash, because they always do eventually. During the spring 2025 market correction from February 20th to April 8th, the MSCI World Index fell 16.2%. But the MSCI World High Dividend Yield Index only fell 9%. That's a 7.2% cushion, and it demonstrates why dividend-paying stocks typically experience lower volatility. Companies that pay consistent dividends tend to be mature, profitable, stable businesses. They're not going to make you rich overnight, but they're also less likely to crater during panic selling. This defensive characteristic is one of the biggest advantages of dividend ETFs, especially if you're someone who gets nervous during market downturns. However, and this is important, this stability comes with a trade-off. During raging bull markets dominated by growth stocks, dividend ETFs will lag behind. From 2010 to 2025, the S&P 500 crushed most dividend-focused funds because non-dividend-paying tech giants like Nvidia, Tesla, and Amazon delivered outsized returns. SCHD's 11.15% is excellent, but it still trails the S&P 500's 11.68% over the same period. You're giving up some upside potential in exchange for higher current income and lower volatility. Let's be completely honest about the risks, because this isn't a perfect strategy. First, companies can and do cut dividends during economic downturns. Even quality companies reduce payouts when earnings fall. That's why diversified dividend ETFs are better than individual stocks, because they spread this risk across dozens or hundreds of holdings. Second, dividend portfolios tend to be concentrated in sectors like utilities, real estate, energy, and consumer staples. These are traditionally stable dividend payers, but they can underperform during periods of economic disruption or rapid technological change. Third, while some dividend-growing companies increase payouts over time, dividends alone may not fully protect your purchasing power during high inflation periods. And fourth, if you're young and have a long time horizon, going all in on dividend ETFs means you might miss some of the explosive growth that comes from younger, non-dividend paying companies investing heavily in expansion. So when does this strategy actually work best? There are 6 conditions that need to align for dividend ETF investing to be your optimal path. First, you need a long time horizon, at least 10 years, but preferably 20 or more, because compounding needs time to work its magic. Second, you must set up automatic reinvestment and never touch those dividends. The moment you start spending them, you kill the compounding engine. Third, you need access to tax-sheltered accounts, or the tax drag will significantly reduce your returns. Fourth, you should make consistent contributions using dollar cost averaging to buy shares at various price points and reduce timing risk. Fifth, choose diversified ETFs like SCHD or VYM rather than concentrated high-yield funds that might be riskier. And sixth, you need the patience to stay invested through market cycles. Bull markets, bear markets, corrections, crashes, you have to ride them all without panicking and selling. Here's the bottom line after analyzing all this data. Placing every dollar of your savings into quality dividend ETFs with automatic reinvestment is mathematically powerful. That $10,000 growing to $82,830 over 20 years is real, verified performance. The 85% cumulative return attribution to dividends from 1960 to 2023 shows the incredible long-term power of compounding, even though current period dividend contributions are lower at 23 to 34% annually. But you need to understand the trade-offs. You'll likely underperform the broad market during growth stock-dominated bull runs. You're vulnerable to dividend cuts during recessions, and you'll face ongoing tax complications if you're not using tax-advantaged accounts. This strategy isn't for everyone. If you're a short-term trader looking to flip stocks for quick profits, this isn't your game. If you're chasing maximum total returns and can stomach high volatility, you might be better off with S&P 500 index funds. And if you only have access to taxable accounts, the tax drag might make this less attractive. But if you have a long time horizon, you want consistent income, You prefer lower volatility than growth stocks, and you can invest through tax-advantaged accounts. Then reinvesting every dollar into quality dividend ETFs remains one of the most effective wealth-building strategies available. Think back to that question I asked at the start. What if every spare dollar actually worked for you? The math shows it's possible. 10,000 becomes 82,000. Every skipped impulse purchase, every bonus, every tax refund, when funneled into dividend ETFs and left untouched, compounds into real wealth. The strategy works, but only if you let it. Time in the market beats timing the market every single time. So here's my challenge to you. Run your own numbers. Figure out how much you could realistically invest each month. Calculate what that could become in 20 years using these returns. Start small if you need to, but start. And whatever you do, enable that automatic reinvestment and never look back. Every dollar has a job. The question is, are you giving it the right one? If this breakdown helped you understand dividend ETF investing better, hit that like button and subscribe, because I'm breaking down more investment strategies with real verified data. Drop a comment if you have questions about SCHD, VYM, or dividend investing in general. I'll see you in the next one. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.